talk about value at risk, or VAR for short. I'll break it down into simple parts so it's easy to understand. 1. Understanding risks. First, let's talk about different kinds of risks. Market risk. This is the risk that comes from changes in the market, like stock prices, interest rates, exchange rates, and commodity prices. Credit risk. The risk that a borrower might not pay back a loan. Operational risk. This is the risk of loss from failed internal processes, people, or systems. Liquidity risk. The risk that an asset can't be sold quickly enough to prevent a loss. For now, we'll focus on market risk because we have a lot of data on things like stock prices, which makes it easier to analyze. 2. What is VAR? VAR is a way to measure market risk. It tells us the minimum loss we might expect over a certain time period at a certain confidence level. Let's break this down. Confidence level. This is usually 90%, 95%, or 99%. It means we're that sure the loss won't exceed a certain amount. Holding period. This could be 1 day, 1 week, 2 weeks, or 3 months. It's the time over which we measure the potential loss. For example, if we have a 95% confidence level and a 1-day holding period, we're saying there's a 95% chance our loss won't be more than a certain amount in 1 day. 3. Components of VAR. There are 3 main parts to VAR. Confidence level. How confident we are in our estimate, e.g., 95%. Holding period. How long we are looking at, e.g., 1 day. Minimum loss. The smallest amount we expect to lose at that confidence level over the holding period. 4. How to interpret VAR. Let's say we calculate VAR and find that at a 95% confidence level over 1 day, the VAR is $1 million. This means there's a 95% chance we won't lose more than $1 million in 1 day. Conversely, there's a 5% chance we could lose more than $1 million in 1 day. 5. Real-world example. Imagine a statement like this, with a 95% confidence level, we expect our daily loss to be at least $1 million 5% of the time. This means out of 20 trading days, we expect that on one of those days, the loss will be more than $1 million. Summary. VAR is a tool that helps us understand and measure market risk by estimating potential future losses based on historical data. It uses a confidence level to tell us how likely it is that losses will not exceed a certain amount over a given period. Remember, VAR is about potential future losses. So it's forward-looking even though it uses past data to make predictions. Alright, let's continue with our explanation of VAR by talking about the profit and loss, P&L, distributions and how they relate to the concept of VAR. P&L distributions. Imagine we have 2 plots in front of us. These plots help us understand how we move from a non-standard normal distribution to a standard normal distribution using something called a z-score. Top 2 plots, non-standard versus standard normal distribution. 1. Non-standard normal distribution. This distribution has a mean, average, and a standard deviation of sigma. For our example, mean equal 3 and sigma equal to 2. Standard normal distribution. This distribution has a mean of 0 and a standard deviation of 1. To convert a point x from the non-standard distribution to the standard normal distribution, we use the formula z-score equals x, nu, sigma. Example. Let's say we have a point x equals -1 in our non-standard normal distribution. We plug these values into our z-score formula. Z-score equals x, nu, sigma, we get value -2. Which tells us that x equals -1 in the non-standard distribution maps to -2 in the standard normal distribution. Essentially, We're saying that x equals -1 is 2 standard deviations away from the mean in the standard normal distribution. Bottom plot, determining the cutoff point. The bottom plot helps us determine the cutoff point for our confidence level. This cutoff point is crucial because it tells us where our VAR number lies on the loss tail, left side of the distribution. Confidence level and significance level. The confidence level is how sure we are about our VAR estimate, e.g., 95%. The significance level is the percentage that complements our confidence level, e.g., 5% if our confidence level is 95%. Finding the VAR cutoff. To find the VAR, we look at the left tail of the distribution, where the losses are. We determine the point on this tail that corresponds to our significance level. This point is our cutoff point. The value of x at this cutoff point is our VAR. Example, if our confidence level is 95%, our significance level is 5%. We look at the left tail of the distribution and find the value of x that corresponds to the 5% mark. This value is our VAR, representing the minimum loss we would expect 5% of the time. Summary. By understanding the relationship between non-standard and standard normal distributions, we can convert outcomes using the z-score. This helps us determine the cutoff point on the left tail of the distribution, which in turn allows us to calculate the VAR. The VAR gives us a clear idea of the minimum expected loss over a certain period with a given confidence level. Let's discuss how we calculate value at risk, VAR. There are 3 main methods to calculate VAR, and I'll explain each of them in simple terms. 1. Methods to calculate VAR. Parametric method, also known as analytical method or variance-covariance method. This method assumes that returns are normally distributed. It uses statistical measures like mean and standard deviation to estimate VAR. Historical simulation method. This method uses historical data to simulate potential losses. It looks at past market movements to predict future risks. Monte Carlo simulation method. This method uses computer simulations to model a wide range of possible outcomes based on random sampling. Steps to calculate VAR. Step 1. Mapping portfolio holdings to risk factors. First, we need to identify the risk factors that affect our portfolio. For example, if we have a portfolio that includes a convertible bond issued by a foreign company, the risk factors might include currency risk, the risk that exchange rates will change. Equity risk, the risk that stock prices will change. Yield curve risk, the risk that interest rates will change over different time periods. Credit risk, the risk that the bond issuer might default. Step 2. Gathering data history. Next, we need to collect historical data for each of these risk factors. Even though the parametric and Monte Carlo methods don't strictly require historical data, it's often useful to have it as a starting point. However, for the historical simulation method, historical data is absolutely necessary. Step 3. Determine the cutoff point. Finally, we need to determine the cutoff point, which involves using the significance level. The significance level is calculated as 1 minus confidence level 1 minus confidence level. For instance, if our confidence level is 95%, our significance level will be 5%. This step helps us identify the point at which we expect to see our minimum loss, or VAR. Summary. To summarize, calculating VAR involves 3 main methods: the parametric method, the historical simulation method, and the Monte Carlo simulation method. The typical steps include mapping portfolio holdings to relevant risk factors, gathering historical data for those risk factors, and determining the cutoff point using the significance level. These steps help us understand and estimate the potential future losses of our portfolio, giving us a clearer picture of the risk involved. Let's dive into the parametric method for calculating VAR, step by step, using simple language. 2.1 Parametric method. Step 1. Model assumption. The parametric method assumes that the return distributions for the risk factors in the portfolio are normal, like a bell curve. But it's not required. We can use more accurate distributions that take into account things like skewness, how much it leans to one side, and kurtosis, how heavy the tails are. This is especially important for assets with a fat left tail, which means there's a higher chance of extreme negative returns. Step 2. Portfolio holdings and risk factors. Let's say our portfolio maps to n risk factors, each with an annualized return nu_i, weight w_i, and annualized volatility sigma_i. Step 3. Expected annual return. The expected annual return of the portfolio is calculated as the weighted average of each individual annualized return. This means we take each return, multiply it by its weight, and then sum them all up. Step 4. Annual standard deviation. The annual standard deviation of the portfolio return is calculated using a specific formula that considers the volatilities of the individual risk factors and their correlations. Step 5. Calculate daily return. Assuming there are 252 trading days in a year, we calculate the daily return by dividing the annualized return by 252. Step 6. Calculate daily volatility. Similarly, we calculate the daily volatility using the annual volatility and adjusting it for 252 trading days. Step 7. Determine VaR cutoff point. To determine the VaR, we use the formula VaR equals nu sigma times z_score. Step 8. Find the corresponding z-score. We need to find the z-score that corresponds to our confidence level. For example, for a 5% significance level, the z-score is -1.65. For a 1% significance level, the z-score is -2.33. Using the formula, VaR equals nu sigma times z_score. Notes. VaR is usually expressed as a positive number even though it represents a loss. That's why there's a negative sign in the formula. The z-score used for VaR calculation is negative. There are two technical ways to calculate annual VaR: annualizing the daily VaR, not the preferred method, annualizing daily return and daily standard deviation, then calculating the annual VaR, preferred method. These two methods will usually give different VaR numbers. Step 9. Calculate absolute loss in dollar terms. To find the absolute loss in dollar terms, multiply the return VaR by the value of the portfolio. Summary. The parametric method uses statistical measures to estimate VaR under the assumption that returns are normally distributed. By understanding the risk factors, calculating returns and volatilities, and using z-scores, we can determine the potential loss, VaR, of a portfolio. This helps in managing and mitigating risk effectively. Let's go over the historical simulation method for calculating VaR, step by step, in simple language. Historical simulation method. Step 1. Use the current portfolio. Start with the current portfolio. It's important to use the portfolio as it is today, not as it was in the past. Using historical portfolios can lead to mistakes. Step 2. Use actual historical returns. Look at the actual historical returns for each risk factor in the portfolio over a specific period, look-back period. This means gathering past data for things like stock prices, interest rates, and exchange rates. Step 3. Consider data point weighting. When using historical data, you can either equal weighting, treat all past data points equally. Weighted data points give more weight to recent data and less weight to older data. This approach assumes recent trends are more relevant to current risk. Step 4. Sort the results. After calculating the portfolio returns based on historical data, sort these returns from the largest loss to the greatest gain. This sorted list helps us see the distribution of possible outcomes. Example, using current portfolio. Imagine your current portfolio includes stocks, bonds, and some foreign currency. Collecting historical returns, gather the daily returns of these assets over the past year. Weighting data points. Decide whether to give all past returns the same weight or to prioritize more recent returns. Sorting returns. Once you have all the returns, sort them from the biggest loss to the biggest gain. Determine VaR. To find VaR, look at the left tail of the sorted returns. For instance, if you want a 95% confidence level, find the return at the 5th percentile, the point where 5% of the returns are worse. This return is your VaR. Summary. The historical simulation method uses actual past returns to estimate potential future losses. By analyzing the current portfolio, gathering historical data, Considering how to weight these data points and sorting the results, we can identify the VaR. This method is straightforward and relies on real historical data to give us an idea of what losses we might expect. Finally, let's go over the Monte Carlo simulation method for calculating VaR, step by step, in simple language. Monte Carlo simulation method. Step 1. Simulate returns of risk factors first. We need to create a Monte Carlo simulation model. This model will generate random values for the returns of the risk factors in our portfolio. Think of it like rolling dice to see many possible outcomes for stock prices, interest rates, etc. Step 2. Reprice our exposures next. We take these simulated returns and reprice our portfolio based on them. This means calculating what our portfolio would be worth under each of the simulated scenarios. We do this for each set of simulated returns. Step 3. Sort the results after repricing the portfolio for all the simulated scenarios. We sort the results from the worst, biggest loss, to the best, biggest gain. This gives us a range of possible outcomes for our portfolio. Step 4. Select the outcome at the required percentile. Finally, we select the outcome at the required percentile based on the significance level. For example, if our significance level is 5%, we look at the 5th percentile of our sorted results. This means we find the value where 5% of the outcomes are worse. This value is our VaR. Example, simulate returns. Use a Monte Carlo model to generate thousands of possible returns for each risk factor in your portfolio. Reprice portfolio. Calculate what your portfolio would be worth under each simulated set of returns. Sort the results. Arrange these portfolio values from the worst loss to the best gain. Select the required percentile. For a 5% significance level, find the value at the 5th percentile. This is the point where 5% of the simulated portfolio values are lower, representing the VaR. Summary. The Monte Carlo simulation method uses random sampling to simulate many possible future outcomes for the returns of risk factors. By repricing the portfolio under these simulated returns, sorting the results, and selecting the outcome at the required percentile, we can estimate the VaR. This method is powerful because it can model complex and nonlinear relationships between risk factors.